Good morning, everyone, and welcome to Axiom, Andile's webinar, coming to you directly from, well, as you can see, from my house. And on that point, I just have to tell you that during at any time, if you see a child running in, if you hear a child in the background, when I'm talking to you, or if Richard would be talking to you, please just excuse it. But I think that's a situation where we're all finding ourselves in today. So yeah, today we're going to have a presenter. Richard's going to talk to us about history lessons in volatility. I'm not going to speak too much about that. I'll let him get into that. So that is what the agenda will be looking like today. Richard will be presenting to us in about 40 minutes time, or in a time of 40 minutes. He did say he tried to get it into 40 minutes. He'll try his best to keep it to 40 minutes. And after that 40 minutes, we will then go into a time of Q&A. How the Q&A will work is that we're not going to allow any questions when Richard is speaking. So you will see there's a hand-raising functionality on the webinar, which we will not be using today. You can submit questions at any point during this webinar, and then at the end of the session, Richard will be answering all your questions. We will also be making use of polling the functionality. So you might be asking, well, what is this polling? And I've just shared a poll with you now to test drive the polling and let you practice as well. The question I'm asking you now, which you can answer, is, well, what does Axiom mean? Is it a car brand? You know, it's some kind of Greek word. You have no idea, or none of the above. So you can now submit your answer to that. I'm seeing quite a bit of answers coming through to this. So we will be using the polling at the end as well for a question or so, where you can answer the question as well. So I've got a lot of question or answers coming through. No one has said a car brand as yet. What I'm now going to do is just end this poll and show you the results. So that is exactly it. Axiom is a statement that is taken to be true to serve as a premise or starting point for further reasoning. And that is why we call these webinars Axiom, where we get subject matter experts, we get thought leaders to come and share on their expertise, their area of expertise, which serves as to be true. And from here on onwards, we want to create a method of conversation and of discussion going forward. So that is the reason we call this Axiom, today being the first session. We'll talk more later on just the rest of April. But at this point, I'm going to say less, and I'm going to start handing over to our speaker or presenter for today, Richard. If you are still there, hopefully, because otherwise I'll have to keep the people busy for 40 minutes.
Loud and clear, Albert. Thanks for the introductions. I see at least 95% of our audience knew what Axiom was. I suppose the giveaway was a bit in the LinkedIn thing we sent out yesterday. But thanks, it's an honor to be our first guest on Axiom, and more by luck than by design, being the second guest tomorrow as well. And we are basically going to look at two subjects over the next 2 days. Originally, we wanted to do it as one session, but the material gets a bit long, and sometimes it's a bit abstract, so we thought it better to split it into 2 sessions. So today we're going to be looking at long-term capital management and the impact that had on financial markets in 1998. And tomorrow we're going to look at the great financial crisis from 2007 to 2009. And basically how we decided on these topics was because of COVID-19 and what is happening in the global economy. I mean, it just helps us to give an idea by looking back to sort of see what's happened in the past when there was such severe market volatility. Now, obviously, looking in the past doesn't always give you the answers for the future, but it does help in terms of preparation. So although no one can exactly say what is going to happen with COVID-19 and how all this is going to play out from an economic perspective, it should at least help us to see what lessons we could have learned from past volatility to just make the road maybe a bit less rocky.
Yeah, thanks, Richard. While you were talking, I know it's difficult when you're presenting on a webinar like this, when it's not in a classroom and you don't have a view of who is attending. I've just asked a question to everyone of their experience. How much experience do they have within the banking sector? No pressure on you, but 35% of the attendees have more than 10 years experience, and about 21% has 2 to 5 years experience, and 20% more than 20 years experience. So quite a senior group of people that you are going to be presenting today.
Oh, thanks. Yeah, it's always good. I mean, the aim of these webinars is to try and simplify the discussions as far as possible. So that's my get out of jail free card. I'm going to try and simplify it. But yeah, it was good to see a good spread of experience around the audience, and yeah, hopefully you'll all enjoy this little session.
Cool, great. Richard, I'm going to hand over to yourself. I'm going to stop my video. You can take over with your video and share the presentation, but then I'll be talking to the rest of you when we get to questions later on.
Oh, thanks, Albert. Yeah, as I mentioned before, today we're going to look at long-term capital management. Tomorrow we're going to look at the great financial crisis. Just a little bit about long-term capital management. So they were a hedge fund management firm based in Greenwich, Connecticut. They were founded in 1993. And they used absolute return and arbitrage trading strategies combined with high financial leverage to generate fantastic returns. And they made a lot of money from 1994 to 1997. And then it all went pear-shaped, and they ended up losing $4.6 billion in a matter of 5 weeks in August and September of 1998. And personally, I think this is a fantastic story, because here you've got a firm which was staffed by probably some of the smartest people who's ever walked the face of the earth, supported by some of the richest people who ever walked the face of the earth. And although it was a great success at the start, it ended up being a spectacular failure. And today I'm going to take you through the story. So just a couple of definitions. Just as I mentioned, we're going to try and simplify this because it can get very complex, and we don't want to get stuck too much in the details. So just some definitions to keep in mind. Arbitrage is the simultaneous purchase and sale of an asset to profit from a difference in the price. And basically, it's a trade that profits by exploiting the price differences of identical or similar financial instruments. A simple example of that, let's say Royal Dutch Shell, the shares trades in both the Netherlands and in the UK. And if you can see, it's trading in the Netherlands at $11 a share and in the UK at $10 a share. Basically, you can buy the cheaper share and you can sell it in the Netherlands. So you buy it at $10, you sell it at $11, and you've made $1 profit risk-free without really being exposed to market forces. Obviously, what long-term did was a bit more complex than that, but that is the basic concept. Then a bond, debt investment, in which an investor loans money to an entity. So you get a piece of paper and you pay someone a couple of million of dollars. You purchase the bond, and over time, they either need to pay you interest and eventually return your the full face value of a bond as well. So if you bought a zero coupon bond for R1 million today, which expires at the end of this year, they need to give you back R1 million at the end of this year. Then what's nice about bonds, it's a great way to raise finance as well. And that is typically where you'll be looking at a repo or repurchase agreement, also called a buy-sell back or sell-buyback. You agree to sell something today and buy it back a week from now. And banks quite frequently use bonds in that fashion. So they buy a bond and then they enter into a repurchase transaction in which they borrow money from someone else and they give a bond as collateral. And you'll see long-term capital management make extensive use of those. And the other definition, which is important, is just on the run versus overrun. So in terms of how US finance works, so if they offered, either the US government issued a bond yesterday, that would have been the latest bond, that's called your on-the-run bonds, and all bonds issued in the months and years before that would be off the run. So on the run just refers to the latest bond which has been issued. And why that is important is quite often there's a liquidity premium attached to on the run instruments, they're normally just a bit more expensive than your off-the-run bonds. And that is something which long-term try to exploit in some of their strategies. But before we get into the detail of the story, or to fully understand long-term capital management, we first need to go back to the roots of long-term capital management. And the founder of it was a trader called John Meriwether, who was the head of fixed income arbitrage at Salomon Brothers. So back in the, I mean, if you look at today's financial markets, Goldman Sachs, JP Morgan, Morgan Stanley, all the big investment banks. But back in the 70s and 80s, Salomon Brothers, if you wanted to be the trader earning the big bonus and working in a very innovative environment, Salomon Brothers was basically the most well-known for innovation and for big bonuses back on Wall Street in the 70s and 80s. And John Meriwether was seen as a pioneer of bond arbitrage. And the reason for that is if you go back to the 60s and 70s, typically your bond traders were a bit more salesmen than proper traders working with financial models and using data as a basis to trade on. So they just buy low, sell high, and typically your trader, the guys who performed well were more the people who will be able to sell ice to Eskimos than people who maybe had a more analytical type of mindset. And so, I mean, John Meriwether started his career in that environment, and he sort of wanted to change that because he believed that by using data modeling and using data as a basis, that there were better ways of making money on bonds rather than just buying low and selling high. So he started playing around with this idea, and what he did was he got the name of a professor economics professor at the University of Harvard, and he gave this professor a call, and his initial plan was to see if a professor could give him a name of 5 or 6 whiz kids in his class, and then he could train them up to become bond traders and implement these new strategies based on models that he wanted to use to make money with. And he spoke with a professor, and after a while the professor was so impressed, he said, well, rather than me giving you the name of 5 or 6 people in my class, how about I just come and work for you? And John liked the idea, and that was sort of the start of his recruitment strategy, and he went through the whole of the states looking for more people trained in mathematics and finance to try and turn them into bond traders. And it wasn't a very popular idea at first because I mentioned typically your more charismatic salesmen sort of dominated the trading floors at Salomon Brothers in those times. So now you had a bit of this disconnect. You've got these unruly, loud traders versus these quiet intellectuals, the nerdy professors with their models and their data analytics. But over time, as they started trading and the way they were using bond arbitrage to make money, it generated a lot of money and eventually a lot of respect at Salomon Brothers. And this bond arbitrage desk of John Meriwether did so well that at its peak, it was responsible for 80% of Salomon Brothers' global earnings. So it was incredibly successful. So things were going very well for John and his band of nerdy professors. And then sort of disaster struck. They had a problem. One of the traders was involved in a fraudulent scheme. In terms of US regulation, when you trade in the bonds, in government bonds, one entity is only allowed to bid for 30% of the issue of any new bond. And the reason for that is the government doesn't want one party or one company to monopolize a whole bond issue and control the price that way. So you're limited, you're only allowed to bid for 30% of bonds being issued. And this trader under John Meriwether put in a bid for 30% for Salomon Brothers, and then he put in fake bids under the names of clients. And the clients didn't know about it, so he just used their name to gain access to additional bonds. And this trader actually confessed to it, and John Meriwether was shocked. It was not something he sort of stood for, and he followed the right channels, and that he said to the CEO and the compliance and the legal team to say, look, we've had a problem here. One of our traders has violated securities exchange regulations. And sort of a strange thing happened then. They all knew they needed to report it to the appropriate authorities, but they weren't sure who to speak to or when to do it and what to say. So they sort of sat on this. And eventually the SEC, the Securities Exchange Commission, caught word of it. There was an investigation and chaos reigned. The trader was sent to jail. He was fined $1 million as well. The CEO of Salomon Brothers was fired, and John Merriweather, even though he had sort of done the right thing and escalated this problem, this fraudulent behavior from one of his traders, had to leave Salomon Brothers as well. So at the end of Salomon Brothers, he left there in August of 1991. He was quite bitter because he sort of felt that he did the right thing, and yet he got punished. But it didn't take a long time for him to start planning his comeback. He started recruiting for a hedge fund that he was going to call Long-Term Capital Management in 1993. And obviously the partners of his firm draw heavily on the bond arbitrage desk from his Salomon Brothers days. So why he chose the vehicle of a hedge fund is because if you look at hedge funds, the regulations around them are very loose. So typically how a hedge fund works, you're not allowed to have more than 100 investors, and every one of those investors needs to have invested a minimum of $1 million. And the thinking behind that from the US government is that if you've got $1 million to throw around into these little ventures, then they don't have to worry about looking after you from a financial perspective. So because there wasn't as much regulation as in banks, it allowed John and his team to become more exotic in the type of trades that they did and take more risk on. So of the 16 partners he recruited, 12 came from Salomon Brothers and 6 had PhDs from MIT. So it was quite a smart team. And then he had quite an interesting coup, and he managed to recruit Robert Merton and Myron Scholes. I don't know, the guys of you who work in banking, you've probably all heard of a Black-Scholes Merton model, which is used to value options. So they designed this model back in the mid-70s, and most banks to this day use the Black-Scholes model to value their options. So they were very well known, almost like banking or financial services rock stars, if you will. And then he had another school. So he managed to recruit David Mullins, who was the vice chairman of a Federal Reserve Bank and seen as a potential chairman of a Federal Reserve Bank in the US. And sort of a message that got sent by him appointing this vice chairman of a Federal Reserve was, although they had problems at Salomon Brothers and mistakes were made, basically all was forgiven from a government perspective, and they would support long-term where required. So they start on this new hedge fund, and obviously they have to raise capital. So they contact Merrill Lynch and say, can you please raise for us $2.5 billion? That was the original target they had in mind, but they only could get up to $1.25 billion. But at that stage, it made them the biggest startup company in the history of the world. So they only got off, but that still made them the biggest ever. But before they could start raising money, they had to go on the road shows. And it was a bit of they struggled to attract funds right at the start. One of the main problems was they had quite high fees compared to other hedge funds. So what they charged annually was 25% of profits and 2% of your gross assets per year, whereas the industry standard was 20% of profit per year and 1% of your gross assets. Plus there was a 3-year lock-in period, which is sort of unheard of from a hedge fund perspective. Normally the guys are free to come and take out their funds as they wish, although there will normally be penalty fees involved for early redemptions and that. And the other thing which made it difficult for them, so their terms were a bit more unfavorable for investors compared to the other hedge funds. The other thing was they were quite secretive as to how they intended to make this money. So basically they just said to investors they're going to use relative value arbitrage strategies and they're going to use high forms of financial leverage. And because they were sort of vague, they didn't go into too much detail. Obviously, if you're an investor and people want to ask you for $50 or $100 million, you sort of want to know why, what are they going to be doing with your money. So at the start, the funds trickled in slowly, and then they had a bit of luck in that Salomon Brothers changed their financial reporting to a more granular breakdown, and they restated it for a couple of years back, and that sort of showed how influential and how profitable this bond arbitrage desk of John Merriweather was in the Salomon Brothers days. And sort of when they had that, now they had proof, look, what we've done has worked well in the past. And by using the same playbook, we think we can make money for our investors that way. Plus the other benefit they had was with the presence of a central banker in their lineup, that gave them assets to quasi-government money. So yeah, the Kuwaiti Pension Fund, the Italian Central Bank, Singapore Investment Corporation, all basically state entities depositing $100 million each as investments into this new hedge fund. And normally, government money wouldn't really come near to a hedge fund. So they managed to get up to their $1.25 billion, and they opened for business at the end of February 1994. And then they had a second slice of luck in that at that same time, the US Federal Reserve hiked their interest rate by 25 basis points, and it had been the first hike in 5 years. And this was sort of unexpected, and it rattled the markets a little bit, and it triggered big volatility in the market, and a couple of pension funds lost big money. George Soros, as one of these funds, lost upward of $600 million. So this had quite a big impact on the financial markets in the US. But this volatility was basically what long-term thrives off. As soon as there's a disconnect between prices and the market, it allows them to execute their relative value arbitrage strategies. And they did their first trade, and they called it a snap trade. And this first trade involved a US 30-year bond pair. And they placed a trade worth $1 billion, basically their whole capital number. And they made $15 million without using any cash by employing leverage. And we'll have a bit of a more in-depth look at the mechanics now. So roughly what the disconnect they saw in the market was that there were bonds issued in August 93, expiring in August 23, had a yield of 7.24%. And the bonds expiring in February 2023, which was issued in February 1993, had a yield of 7.36%. And if I looked at this logically, both how those bonds would work, it's worth $1 billion. And they were saying a bond expiring in August 2023 as opposed to February 2023, 30 years from now, the risk is the same. You cannot say at this stage that there's more risk attached to the one than the other. Why shouldn't their yields be exactly the same? So that was the price disconnect that they were trying to exploit. And at the end of that first year, they'd made a return of 28%. And that was after the fees. So a very good return. And now we're just going to have a bit of a closer look at the trade mechanics they used on those US bond pairs. And roughly what they did, if we take a look at a simple example, on day one, they borrow $1 billion from Bank A, and then they use that $1 billion to buy US bonds issued in February 1993, so the offer run, so they buy the cheaper bond, because remember the more liquid or the on the run one is normally a bit more expensive than the offer run, and they pay out $1 billion in cash. And then they enter into a sell and a buyback or a repo transaction. So they sell the bond and they agree to buy it back at a later date. Normally these instruments are fairly short-term in nature. So they sell the bond and they get $1 billion in cash. So the bonds are placed as collateral and they've got $1 billion in cash. So then they use that $1 billion in cash and they enter into a second repo transaction, a buy-sellback or reverse repo. And they buy $1 billion of US August 93 issue, the on-the-run bonds, and they place that $1 billion as cash collateral. And then they take those bonds, the August 1993 issue, and they sell it in the market and they receive another $1 billion in cash. So now they can repay that loan that they've had to the bank. So through the magic of financial engineering, they haven't used any of the cash, or cash is net zero, but they've managed to put a trade with $1 billion on the book. And here is just sort of a breakdown to give you a bit of a more detailed view as to what the risk on the bond would be, because arbitrage in its purest form is risk-free, but as we've sort of seen over the last couple of years, quite often these things can unravel quite badly if people do not understand all the risk involved. And so roughly, if you look, you had the August 93 issue bond and the February. So the August is the on-the-run one, the latest issue, the February is the overrun. So you can see the August 93 is a bit more, the price is 92.76 as opposed to 92.64. There's a 12 basis point spread, but the risk is virtually the same as both expire 30 years from now. And sort of to keep those trades on book, as long as the spreads keep widening, it adds risk to the business. So if we look at that second scenario where the price increases of a August 93 issue goes from 92.76 to 92.88, and the February bond decreases from 92.64 to 92.55, so that spread widens. And when that happens in that column to the right, you see what happens from a collateral place perspective. As they do their repos, they are bleeding cash the longer those spreads go wider. Because if you look at this, I mean, it's quite a complex structure they've put together, but basically the real risk only sits in these two, the two repo transactions. So as the spread widens, long-term starts bleeding cash. As it widens more, they bleed more cash. But generally what happens over time is, over time, those prices, because the risk is the same, sort of move together. And as soon as those prices snap back together, they've basically locked in their profit and they can exit out of that whole structure. So as long as you know, just to sort of keep those trades going, while the spreads between the different bonds widen, they start bleeding cash, but as soon as it snaps back together, they've locked in their profit and they can exit the trade. That is how they made money. And here's just a yield curve, just to sort of give more a different view as to why risk would be the same. So if you look at a standard yield curve from 0 to 30 years, so these were 30-year bonds. They purchased the one expiring February 2023, the other one August 2023. And you can see, if you look at the curve, the risk is virtually identical. So, and that is what they were saying. It's illogical for bonds expiring 30 years from now in February to be cheaper than bonds expiring 30 years from now in August, because there's no way you can say at today's rates that the one is more risky when compared to the other.
Hi, everyone. If you can hear me, I just think Richard is just frozen there. So just bear with me for a couple of seconds while we get him back on the air. Thank you. Richard, are you back? Richard, just check. I think you're on mute.
Okay, I'm back. Sorry, guys, I lost you guys there.
It's okay. It's part of the situation that we're all in, people working from home. If I have to tell you the amount of times I've been on conference calls over the past couple of weeks, and people saw my face in a very awkward position because of my screen freezing. Yeah, I would have been a millionaire if I had $1 for every time that happened. It's part of the situation we're in. For all the attendees out there, I do apologize for that. Now, I just ask for a bit of grace in this time. Next time that happens, I assure you I will be taking it over and I will be telling you more about the world of sports.
Thanks, Albert. Yeah. Sorry, guys, for losing you there. So I was just talking about relative value arbitrage, and typically their strategy there would be an example of that. Royal Dutch Shell shares, which trades in both London and in the Netherlands. The Netherlands shares are, the market there is a bit more liquid, so typically the price is a bit more expensive than in London. So they'd say, okay, this is the same company listed in 2 different countries. At some stage or another, the prices should converge. And then they also traded in European bonds, equities, interest rates, swaps, and options. So they believe they're quite well diversified in terms of what they try to do. And things went well. I mean, we already mentioned they earned 28% after fees in 1994. Then they earned 43% in 95, 41% the year after that, and 17% in 1997, which are all post-fee returns, which is fantastic. I mean, if you're investing money, you would be extremely happy if that's the returns that you were earning. And then in 1997, I mean, 17%, still good. But what they sort of started seeing was, as the people became more aware of what they were doing, I mean, they always say, copy, it's basically a compliment if people start copying what you do. And that is what happened here. As they were making money, people started hearing about how much money that long-term capital management was making. And obviously all the Wall Street banks wanted to have a piece of it. To just quickly step back, I mentioned earlier they're quite secretive. And actually, if I go back to those trade flows, you'll see to the right on the counterparties, counterparty A, B, C, and D. When they did these trades, they did the legs with separate counterparties so that no one had an overall view of their book. Because they were so paranoid that someone would copy their strategies. And then they were also good at communicating with their clients, and they sort of sent out a circular to the clients on a monthly basis. And normally in there they said, look, based on price movements, our expectation is that the chance of you losing more than 20% of your capital in any given year will only happen once every 50 years. And then they were also quite arrogant with the other players in the market, so Wall Street and all of those guys. Obviously, they wanted long-term's business because long-term was making a lot of money. But long-term was very secretive. They were very tough negotiators when it came to fees and margins and all of that. They always placed the minimum amount of margin required to. Their fees were very low. And the banks didn't really like trading with them. They said whenever they trade with long-term, only long-term benefits. No one else really makes money from long-term capital trades except for long-term. And these guys believed that their models were infallible. They believed they had the best and the brightest. And for a long time, they were probably proved right. But with that type of success comes arrogance. And we mentioned earlier that in 1997, they only earned a return of 17%, still good, but much less than the previous year. And at this stage, the fund had almost $7 billion in equity. And sort of what happened was, as other banks started copying their strategies, quite often long-term, their models would detect a mispricing between bonds or between stocks or some other government security, and they put everything in place. And as soon as they want to execute their trade or their snap trade, because they'd identified the mispricing, the opportunity would close, the prices would converge, and they always said, someone else has seen what we're doing. They're basically copying our strategy. That's why these opportunities are disappearing. And so now, because the returns were falling, or the return on equity, they sort of came up with a strange plan. And quite an arrogant thing. They actually said, look, they're past the 3-year lock-in now. How about if they return all the original investors' money to them? So they basically said to them, look, thanks for helping us out when we needed you, when we needed your hundreds of millions of dollars. But now we're big enough and strong enough to operate on our own. Please take your cash, get out of the building. Obviously, that was a very unpopular move from an investor perspective, because they'd been earning these great returns they wouldn't be able to get anywhere else. And now long-term had kicked them out of a fund. So that left quite a bad taste in all the investors' mouths. And so what that had also done, because they returned so much investor money, it increased their leverage from 18 to 1. So if your leverage is 18 to 1, it's basically saying for every $1 of your own money that you're using, you are using $18 of borrowed funds. And when they returned this capital to their original investors, the leverage increased from 18 to 1 to 28 to 1. And as 1997 rolled on, everyone was happy. They were making money. Life was good. They'd annoyed a few investors, but you can't make an omelette without cracking a few eggs. Towards the end of October, Merton and Scholes were heard that they were going to be awarded the Nobel Prize for Economics for their valuation model, the Black-Scholes-Merton model. They'd been informed they're going to win the Nobel Prize for that, or they'd been awarded the Nobel Prize. And then another bit of news, which no one had really noticed, was Russia had been downgraded towards the end of 1997. But nobody had really paid much attention at this stage. So as 1998 started rolling on, there were further and further downgrades of Russia's debt. And every time that would spook the markets a little bit, and then it would calm, and then there'd be another downgrade. And there were big fears about the Russian currency. So at that stage, the ruble was operating on a peg of between 6 and 7.5 rubles per dollar. And at first, the Russian government said they'd honor that peg and they'd sell as much foreign currency reserves as is required to keep that peg. And to try and keep that peg going, at one stage, their interest rates led to 200%, their short-term interest rates. Now, there's an inverse relationship between interest rates and bonds. So if interest rates goes up, the value of bonds goes down. And if interest rates go down, the value of your bonds goes up. So if interest rates leaps to 200%, basically the value of your bonds halves. So obviously from an investor perspective, everyone bailed out of Russia and Asia, and the safe haven is your most liquid assets, US Treasury bonds. So now there's panic in the markets, and what happens? Your prices start diverging between different securities. So normally this is fairly good hunting ground for long-term arbitrage trading strategies. But then something else happened which no one thought was possible. On 17th of August 1998, Russia made an announcement, and they said to all bondholders, at the end of this money, we're not paying you any coupons or any of the value of your bonds. We'll only pay our government employees at the end of this month. So basically a default, a credit default, and this sent shockwave through the markets. And obviously now Russia could no longer keep that currency peg going, so the currency went from 7.5 rubles against the dollar up to 21, 22 against the dollar, losing more than 60% of its value in a couple of days. And this now really starts hurting the world economy, and everyone starts panicking. And that leads to a further capital flight out of emerging markets. I mean, if you look at bid-offer spreads, normally in calm times when the economy is doing well, your bid-offer spreads tends to contract. There's not as much risk. But then as soon as there's volatility or uncertainty in the market, those prices spread out. And I mean, we've seen that with COVID-19 now as well. When there's uncertainty or volatility in the market, emerging market countries tend to get hurt first. So on Friday, the 21st of August 1998, when long-term did their P&L for the day, we saw they'd lost $553 million, which was 15% of their capital. As per their models and their value at risk, the maximum expected loss on any given day was 35 million. Now in one day, they'd lost more than 550 million. So they were in deep trouble. So where everyone was in a good space a couple of weeks ago, this Russia credit default really wrecked the global financial markets. So now August goes on, and after this news of a default, obviously all the spreads keeps on widening. And remember what happens on the trades, as if the spreads widen, that is where they have risk, because now they're bleeding cash on the repo transactions that they do. And now long-term saw another thing which they were surprised by. They thought they were well diversified, but they were actually losing money on all the trades they had put on their books. And the reason for that was, although they thought they were diversified in different countries and different instruments and different views on the market, high level, they were always doing the same thing. Spot the price discrepancy, buy the cheaper one, sell the more expensive one, and wait for the prices to converge. So actually, they weren't as diversified as they thought. And obviously, this came as a big shock to all their partners. They started bleeding money on all their trades, and all of a sudden they need to raise cash. And now the act of giving back the original investors, sending them back 2.7 billion, really comes back to haunt them. At the end of August, long-term had lost a further $1.9 billion, which basically meant they'd lost 45% of their capital in no time at all, leaving it with a capital of only $2.28 billion, and now their leverage has gone from 28 to 1 to 55 to 1. So now, whereas in the past they were very arrogant with the other Wall Street banks, the Goldman Sachs, the Merrill Lynch's, Lehman Brothers, and all those people. Now they needed them. And so they started phoning up the banks to see, do they have cash to try and help long-term through this period of market volatility? And I mean, so the banks were willing to help them, but obviously before you lend out money, or before a bank lends out money to anyone, they want to see what it is that they're doing. And long-term didn't want to show their trading positions to other companies because they were always worried that they'd copy their strategies or use the information to trade against them. But in the end, they had no choice but to open up their books. And for years afterwards, they still said, we would have survived, but because the other banks saw our positions, they conspired against us, and that's what led to us losing our firm. And at the end of August, John Merriweather believed at this stage they needed $2 billion to survive. So now August rolls over to September, and first thing in September, more bad news. Now Brazil is starting to get downgraded on their credit rating. It seemed like this credit illness was spreading. I mean, if you look at the world today, I mean, all the markets are very interconnected, electronic trading, information travels very quickly. Those days were sort of just the beginning of that. This was sort of the first crisis which reverberated right around the financial world. Previously, the crisis tended to be focused on little pockets, Europe, America, Asia. But this crisis was the first full-blown global one. And so this credit illness seemed to be spreading, and now the Wall Street banks started to have conference calls with the investors and the analysts, and they start announcing that they're actually losing money as well, because now they've tried to copy what long-term is doing. Now the market is moving against everyone. They're starting to bleed as well, and this causes more uncertainty and more volatility in the market. And these partners from long-term capital management are starting to get desperate. They phone up high net worth individuals, they phone up Berkshire Hathaway, they phone up George Soros, Warren Buffett. And actually George Soros said to them, look, he's willing to give them $1 billion. If they can raise $1 billion from other investors, he's willing to put in $1 billion to try and see them through this difficult time. But as we all know, when times are tough, friends tend to be few. The other problem that long-term had, because they always traded in such big positions, if we look back at that first US bond trade that they did it on a trade of a notional value of $1 billion. And all their trades were very large in size. It's a little bit like having a property portfolio of 20 properties, and the lowest or the minimum value property is $10 million, and all the rest are more than $10 million. So now if you've got to pay a bill of $2 million or pay something and you need to raise cash, now you need to sell a property. It's a lot harder selling a $10 million or $5 million property than a $500,000 or $200,000 property. So this was causing big liquidity issues. The other issue which long-term had earlier on, when I showed you that all the legs of the trade, that US bond trade was done with different counterparties, because they did that, quite a number of times their trades would actually have offsetting risks. So it would reduce the overall risk profile of a trade. But because they booked the legs with separate banks, they only saw the one leg. So none of their risk were netted off against each other, which meant that their margin requirements shot through the roof. So at one stage they said, okay, let's try and pick up our trades and place them all with the same banks. But that meant they had to try and work through 60,000 legs of trades. And to try and match them with a correct bank based on the couple of weeks they had at their disposal was just not a viable proposition. So as we go into September, from 10th of September to the 16th of September, the daily losses read as follows: down $145 million, down $120 million, down $55 million, down 87, down 122, another $500 million gone in the matter of a week. And then the cherry on top, Monday, the 21st of September, 1998, long-term loses another $553 million. Their leverage has now gone from 18 to 1. Then they returned the funds to the original investors to 28 to 1. Then Russia happened at the end of August. They were sitting at 55 to 1. Now they are sitting at 100 to 1. Basically, they are in threat of imminent collapse. And whereas at the end of August, they thought they needed $2 billion to survive, now that number had doubled to $4 billion. And at this stage, John Merriweather realized it was time to ask government for some help. Because he remembers from his Salomon Brothers days is when the going gets tough, you'd rather have a regulatory bodies on your side than in the opposite corner. So he made contact with the appropriate authorities and he said, look, we're having this problem, we're having liquidity issues, we've got big exposures to other banks. And the US Federal Reserve organized a meeting in the New York building with all the major Wall Street firms. So you had the CEOs there of Goldman Sachs, Merrill Lynch, Trust Bank, Chase Bank, all the big players were there. And from their perspective, it's not a place that they wanted to be at. They were all competitors. These guys basically hated each other. They didn't want to hear that some hedge fund that got themselves into trouble and now they need to help out. But from the US government perspective, in essence, long-term capital management was deemed as too big to fail. Keep those words in mind for tomorrow's session as well. So the CEOs were there. The regulatory authorities are saying, look, we're really concerned about systemic risk and that if long-term capital management keels over, it could have a domino impact on the other banks and they fall over the one after the other. And I mean, as I mentioned, the banks didn't really want to be there and they were discussing this. And then all of a sudden, Goldman Sachs put their hands up and say, look, we've got an offer from Warren Buffett. Can all your other banks please leave a room for the big boys to talk? And these other banks hated that even more because they sort of come to help. They didn't really want to, but they were there to help out long term. And now it seems like Goldman Sachs is negotiating behind their back. And Warren Buffett made an offer. So at that stage, they still had capital of about $600 million left at the fund. And Warren Buffett said, look, I'm willing to buy the whole fund for $250 million. And then I'd inject capital of about $4 billion, split 50-50 between myself and Goldman Sachs. And now from a long-term capital management partner perspective, it's not a very nice deal. You had something which was worth close to $5 billion 6 weeks ago. Now someone is offering you $250 million to buy it. So they didn't really want to agree to those terms. And then there's a technical problem with this offer as well. So typically, Warren Buffett said you had an hour to agree to this term, otherwise, to this offer, otherwise it is off the table. But then they made the bid to the wrong company, they had a strange holding structure. So there's technical problems with the legal docs for this bid. So it was a non-starter. So now all those CEOs from the other banks were upset because they were sent out. Now they've been called back in again to say, look, Goldman Sachs' little negotiation trick didn't work. We've still got this problem on our hands. And they started discussing a deal to sort of say, okay, to sort of solve this $4 billion mess, how can we help? And they sort of started throwing figures around to sort of say, okay, we're 14 banks here. If we divide that, that's about $220 or $30 million each. And then there was more ructions because Bear Stearns just said, look, this is a long-term capital management problem. We don't care about long-term capital management. We care about Bear Stearns. We're not willing to invest. And Lehman Brothers said, look, we'd love to help, but we don't have the money to help you guys. We're in big problems. We've got big problems of our own due to bond arbitrage strategies. So they basically walked out of the meeting without contributing. And the other banks basically agreed on a number of about $300 million a bank. So what the Fed did, it was important to note the US government didn't contribute money themselves, but they did arrange this meeting. And they called a press conference evening of Wednesday, the 23rd of September, where they announced to sort of say, okay, we formed this consortium to try and rescue long-term capital management. And by doing this, they sort of gave us interim agreement, degree of finality, which it didn't really have yet, because there's no legal agreement. And I mean, having worked with banks, nothing gets done without 7 or 18 lawyers having a look at it and crossing all the T's and dotting all the I's. So they are very thorough. And so basically they announced that this agreement basically is almost finalized, and they said, okay, legals need to be in place a week later, Monday, 28th of September, which didn't leave much time in place to hammer out this agreement. Specifically, if you think that all these banks who agreed to contribute $300 million each still had to go back to their respective boards and get approval for these deals. So all those 14 banks had to go back and still get the relevant approvals. So on that Friday evening, 70 lawyers, the army of 70 lawyers stormed into the Federal Reserve and started negotiating the terms of this transaction. And they'd almost finished by that Monday morning, they were almost finished with the negotiations. And then Goldman Sachs threw in one final spanner into the works. So Chase Bank had a revolving credit facility of $500 million with long-term capital management. And Goldman Sachs says, look, we're happy with the terms of this legal agreement and this consortium to bail out long-term, but on one condition, which we want to add. We are not willing for that $500 million facility that Chase Bank has with long-term, for that to be settled as part of, through this consortium. We are here to save long-term capital management. We're not here to save Chase Bank. So obviously the CEO of Chase Bank was extremely upset, and he and the Goldman CEO nearly came to blows. But eventually Chase Bank just relented and said, fine, we won't withdraw that facility. So this deal was presented to the partners. A few weeks ago, they were all owned hundreds worth of millions of dollars in this fund. Now they were basically going to get kicked out of it. All their powers was trimmed. In terms of a legal agreement, they're not allowed to put new deals on book. They'd be paid a salary of $200,000 each, which is still not too bad, but compared to the millionaire lifestyle most of them had been leading, bit of a change of scenery. So the aftermath, the final bill for long-term was losses of $4.6 billion, massive losses. And obviously the press had a field day because their question was, why is the government here bailing out hedge funds and rich bankers? What about the man in the street? They don't get any help when one of their small businesses fails. So why are you giving this much attention and money and giving that to long-term capital management? And what also actually happened was the day after they announced the bailout, they dropped the interest rates. And at first, that actually didn't calm the markets. The spreads kept on widening. So that led to even more losses. So although long-term got injected with another $3.625 billion of capital, they lost a further $750 million in the next 2 weeks after the bailout. And by mid-October, as the banks started releasing their results, most of them announced massive losses as well. And that was without taking that $300 million investment into long-term capital management into account. So all those bank shares just bottomed out. There was severe volatility in the market. But eventually the panic and the volatility did die down, and those prices did contract. And the bleeding finally stopped for long-term capital management. So by October of the next year, long-term, or the consortium, had made a profit of 10%, and by early 2000, the consortium had been paid back in full, and they closed down the fund. Lessons learned? Well, apparently nothing, because it was only a couple of years later, and I mean, this is what we're going to be looking at tomorrow, that the next major financial crisis came around. We heard terms like too big to fail being bandied about. We heard about firms not understanding the risk that they were exposed to, complex financial engineering, models not working. Bear Stearns and Lehman Brothers, they were not willing to contribute to the long-term capital management rescue package. And that was quite a big influence in no one really wanting to help them out 10 years later, because they disappeared when the next financial crisis came around. So the main problem here still seems to be that risk management is heavily reliant on financial models. And for most of the time, they are very accurate when markets are calm. But they are unreliable in times of major volatility. And the worst is every time there's a financial crisis, the answer always seems to be, let's bring in more models. Let's make it a bit more complex. And so it almost feels like sometimes the banking sector tends to be chasing its own tail. But I suppose you do have a lot of value in financial markets, but you cannot only rely on models. It's a tool to use. It's not the be-all and end-all. Interestingly enough, after long-term got closed down, John Meriwether and his partners started another hedge fund, JWM Partners hedge fund in 2000. This time I started with seed capital of $250 million, not the $1.25 billion they had previously. And everything went well. And the main difference was that this time they said they were going to keep their leverage to 15 to 1. That's the maximum leverage they were happy with. And they made quite a bit of money. And then from September 2007 to February 2009, the fund lost 44% of its capital. And eventually it was shut down in July of 2009. Just my sources there, but yeah, basically that is the story of long-term capital management. Thanks everyone for listening. Albert, I'm going to hand back over to yourself.
Thanks, Richard. Appreciate that. That was very insightful. I'm going to ask. We've got one last polling question that I'm going to ask the participants if they can take part. But Richard, I've got a question for yourself. You spoke a lot about Warren Buffett, and I don't know if it was originally Warren Buffett's quote, but it goes around. People say one of his quotes says, "What we learn from history is that people don't learn from history." Do you think that's a quote he quoted after all of this? And if he had to quote, what do you think is the main thing Warren Buffett himself learned through all of this?
Yeah, I mean, it's quite interesting. I mean, I didn't mention it in this presentation, but when that trader committed fraud under John Meriwether, when he was still at Salomon Brothers, Warren Buffett had bought a huge stake in Salomon Brothers of about $700 million just a couple of weeks before that came to be known. And when the CEO of Salomon Brothers was fired, Warren Buffett actually took over as interim CEO for Salomon Brothers. And he spent a lot of the time while he was acting a CEO for about 6 months, just firing and trying to root out all the bad weeds at Salomon Brothers. So he was sort of very involved in this whole crisis. And I mean, I think it's a very valid quote. It is difficult though, because no one is well, there are people who say they are fortune tellers, but nobody really knows the future. So from a financial markets perspective, history is a tool that you can use to sort of see what may happen, but it's not always going to tell you exactly what is going to happen. And I suppose one of the problems is when you make use of mathematical models, people who trade these markets are human beings. They're not cold computers. So if they've lost money on a bad trade before, they tend to get spooked. Whereas if it was just cold, hard numbers, they don't get spooked. They're not prone to emotion or losses of logic, whereas people do sometimes act strangely when they are under severe stress. So I think it's a very valid quote. The only thing people learn is they don't learn anything from history, and especially with COVID-19 and what's going to happen. I mean, as I mentioned before, no one can predict what's going to happen in the financial markets, but I'm sure a couple of months from now, we'll know a lot more about what can go wrong within the banking sector.
Yeah, Richard, I'm gonna show the results of that poll, and then I've got to apologize about the last question. The last option would have read hubris and greed, and then the next one would have been inadequate regulation. So what are your thoughts? And this is going to be the last closing point for yourself, Richard. What are your thoughts of the feedback as I share these results?
Yeah, I think, I mean, I try to explain what long-term does very simplistically. But if you really go down into the nuts and the bolts of it, I mean, it gets extremely complex. And when we're going to look at 2007 and 2008 as well, I mean, that's sort of also a feature there. With financial engineering, some of these smart traders come up with these very complex products, which they themselves sometimes don't understand. Their CEOs don't understand it. And it just, every now and then when there's volatility, it just blows up in their faces. It sort of goes wrong. So I agree with the majority there. Well, it's a combination of all of those, because I think what happens is if you've got complexity, if you add leverage to that, it becomes a very explosive mix. And then when you add greed to that, now you've got some serious nuclear energy in there waiting to explode. So, but yeah, agreed. Financial markets can be over complex sometimes.
Well, thank you very much, Richard. We don't have any other questions that came through. That was very insightful. I must say, I'm looking forward to tomorrow's session, talk more about the GFC. So just as a reminder to everyone, This is our lineup for the month of April. So Richard shared today. Tomorrow he's going to continue with the second lesson history on the GFC. Then we've got Milan Mihari speaking to us next week. This is particular to all our Calypso clients, just around accounting and demystifying accounting. It will not just be on focused only on Calypso. So it will be a very good just lesson on accounting, demystifying it for us mere mortal humans. And then on the 22nd, Craig Edwards, who's one of our resources in Australia, will be sharing with us on the state of DevOps, and finishing off at the end of the month, Erik van der Linde on delivery versus payment using distributed ledger. And just a final reminder of then Richard's session tomorrow. That's it for today, everyone. Thank you very much for joining us. If you have any questions or if you want to talk to Richard, you can send an email to axiom@andilesolutions.com. My name is Albert Jansen from Vieren. So thank you very much for joining us. You can email me as well, albert@andilesolutions.com, if you have any questions. But thank you very much. Richard, any closing thoughts or from your side?
Oh, no, just thanks everyone for attending. Hope you enjoyed it, and hopefully I simplified it. I mean, we try and make these complex things more understandable for financial markets. Thanks. Have a good day.
Cheers. Thanks, everyone. Thanks for joining.